Wilshire, please.
Good morning. Daniel Ingram from Wilshire Consulting. Here to present Wilshire's annual analysis of CalPERS active divestment activities through to June 30, 2019. For the benefit of some of the newer members of the committee, we thought it might be helpful just to provide a bit of context to our divestment analysis. There was a bit of discussion in March about what the scope of this analysis is, and we just thought it'd be important to reiterate this is really just about understanding the financial impact, the gains and losses from CalPERS' divestment programs. It doesn't represent a judgment of whether to remain divested or not. That happens now on a 5-year cycle when each divestment program is reaffirmed. That's a much deeper dive into each of the different divestment programs. This is really an annual exercise, a sort of forensic measurement, as it were, of the different programs. So by way of reminder, the 6 divestment programs: tobacco, firearms, coal, Iran, Sudan, and emerging market principles. We include the 2 inactive programs, South Africa and emerging market countries, just to illustrate what the present value of the impact of those programs is. They're not impacting the perf today. So really, we just wanted to step you through, as we did in March. We thought it'd be helpful to look at the next slide, which is an illustrative example of the methodology we use. I won't go into this in too much detail because I think most of you were there when Steve Foresti updated you on this. But really the idea is just to show you, to be able to track the divested dollars. And so you can see from this illustrative example how divested assets are reinvested elsewhere in the portfolio. So you see a very simple portfolio here, 4 securities, security A, B, C, and then the restricted security. That could be in any one of the divested programs. The 4 securities here, A, $45, $27 in security B, $18 in C, and 10 in D. And as we work across, the idea is to show you, when we look at the unconstrained benchmark, that's the benchmark with the restricted or divested securities in the benchmark. We then divest from the restricted security. So if you track that on the bottom line, you track the restricted security, there is a cost from divesting from that security in the form of a trading cost. And then the key point here, as you follow further along to the constrained benchmark, this is the divested portfolio. The key point here to note is that the divested security is redistributed equal to the weighting of securities A, B, and C in the portfolio. I think we spent some time on that last time, but I think it is important to note that that's where the divested security goes into the sort of relative weights of the other securities in the portfolio. I don't want to spend too much time on this top chart, hopefully, but I can take you through it if you would find it helpful. With the specific numbers, I think it's interesting probably more to look at the bottom table, which shows the impact on in terms of dollars on the portfolio. So this is the returns of the constrained portfolio. Over the period, you can see we've used a hypothetical example of 10.08% compared to the unconstrained portfolio of 10.02%. So in this particular case, the divested portfolio outperforms by 6 basis points. And then we take that across. There's a little bit of rounding here. So rather than $6, it comes out as $5.74 5 cents in terms of the dollar impact. I think the other key point that we wanted to note for the example, which is very relevant to how the divestment programs have performed in this financial year, is that as you bring forward the cumulative impact of the divestment gains and losses, even if that divested portfolio or the constrained portfolio is positive, it yields a positive return, the cumulative impact, like in this example, can actually still be negative. And that's actually the case when you look at some of the inactive programs which aren't impacting PERF today. As you bring them forward, they will accumulate in line with the performance of the PERF. So you can see that on the next slide. Actually, let me just pause there on the example. I sort of rushed through it a little bit, but I know some of you have heard this before. I don't know whether it's more useful just to go into the specific numbers of the divestment programs, or whether it's helpful to continue to talk about the hypothetical example.
Well, we have a couple of questions. Let's see what we have. Mr. Perez.
I had turned it off, but I just want to make sure that these are A, B, and C are just examples. They're not specific to stuff that we actually have.
That's right. And just any security, ABC. Right.
Okay.
Thank you. Ms. Taylor.
And he can finish.
Oh, you should go ahead and finish.
Okay, good. So we present two main slides, and then the appendix we include for information, which is the longer back history of each of the individual divestment programs. So there are 2 slides here. The first is since the last affirmation, how have each of the different divestment programs performed? You can see here that just over $2 billion of gain, or 0.6% of the total PERF from the 6 divestment programs since affirmation. Last year, this was about 1.5 billion, or 0.4% of the PERF for the 6 different divestment programs. And this is the chart of the divestment programs since inception. So it's a longer history, particularly for tobacco, where the divestment was initiated in 2001. So here for the active total, we see a loss of $2.269 billion, or 0.6% of the PERF. So 2 different ways of presenting the financial impact, gains and losses of the different divestment programs. And then, as I said, the appendix contains just each of the different divestment programs, their back history and their cumulative impact.
Thank you. Ms. Taylor.
Yes, thank you, Mr. Chair. Daniel, I don't usually see you for this part. Aren't you our ESG guy?
I like to think so. That's a good way to be known.
So I just wanted to go back to your little example, which I appreciate because it does help it explain it. I think I'll get a little confused. So when we take money out of whatever it is, firearms, coal, tobacco, we invest it in the public equities portfolio wide, right? We just, do we pick like the top tier investments to put that money in? How do we do that?
There's no active security selection choice made. There's
there's no money weighted to go into, I don't know, Google or something like that.
Depending on the weighting of that particular security in the benchmark, it will be weighted. So if Google has a higher weighting in the benchmark, then a higher proportion of that divested security will be invested in that security.
And
will
we
be
have-
reinvested in that security.
We have 10,000 investments, and so we take however much money this was, and I don't know how much money we're talking about. Say it's I think you had, is it 100 million here? Yeah, $100 million.
This particular example, I think we said
I think it's
$10,000 here.
Is it?
Much smaller than the
Oh, 10,000,
AUM
okay.
of the perf. We've just used it as an
Right,
example.
which would be really difficult to spread out all over the fund. So that's what I was trying to figure out. So we're just taking it out of one particular investment, spreading it all over the fund. So we're not replacing it with anything. And then my other, I think, statement on this is that, for example, tobacco, we are now losing money in. It's been a 20-year divestment, and it's awfully hard for us to look at, to me, it just seems silly to look at this as a loss. I mean, I get what we're doing here. We're saying, okay, these are the things we pulled out of. This is how much money they've made every year that we could have made, but we're already out of it. So I think it's just, seems ridiculous to me to keep doing this. But now the one that one, two, three, four, EM principles, Sudan, Iran, firearms pending. So you guys are still looking at the program for affirmation? Is that what that means?
Yeah. So I don't know whether Ben or Kit or others want to comment on the cycle of reaffirming, but you can see on that slide 3 that the last affirmation was before my time was for tobacco was, I think that was December 2016, and then that discussion, and then it got sort of officially reaffirmed Q1
Okay, so we
2017,
haven't
so
done
there's
these since the dates over here on the 4th column.
Right.
Is that correct?
I think there's a discussion about what the timetable for that is going forward.
Right. So Daniel's recollection was right. The last time was reaffirmed by lease body was in 2016. At that time, the lease committee decided in 5 years, which is 2021, we'll come back to another deep dive of this topic. But also at the same time in 2016, lease committee decided that every year we come back with you high-level review, such as what Wilshire is doing now today. But then but in 5 years, which is 2021, we do another deep dive of this topic.
Okay. So what is EM principles? I don't even know what that is. Oh, the emerging markets. It says estimates begin in calendar quarter, and it said first quarter 2008. So we haven't looked at that since then?
Affirmed it since then.
I mean, that's what I mean. Affirmed it since then.
You were referring to EM principle?
Yeah. It seems like a long time ago.
Yeah, so I'll leave it.
Yeah, I believe that's the commencement of the program, and it was initially emerging markets countries, and then it became emerging markets principles. And that is correct. None of these, we had originally debated, you may recall, doing the deep dive 5-year review on a staggered basis, but then it was decided it was really more efficient to tackle all of them in the same year. And really the earliest, it does take a big time commitment from staff, so the earliest we figured we could do that would be 2021.
Okay. I was confused. It seemed so long ago. So that explains the rest. We're trying to get on the same cycle.
Exactly.
Okay. And then finally, do other pension plans do the same thing with any divestments? They review this annually and/or longer?
So again, I think a bit before my time, but certainly when I arrived, Steve and the team had done a quickfire survey of, I don't know, Steve, 20 or so other asset owners to see to what extent they are monitoring the financial gains, losses of their divestment programs. I think we were a bit surprised that the sort of the governance around that was probably a bit weaker than we'd expected. Not that many conduct this kind of an exercise. I think we picked out one or two examples here and in Europe. I think we, as Wilshire, we do conduct this analysis for some of the mandated divestments like Iran and Sudan for some of our clients. So, this kind of divestment analysis does go on, but perhaps not on an annual basis.
It's not on an annual basis. Okay. I guess I was wondering if we were, so we're not, or we are outside of what pension funds are normally doing. I guess that's what I was trying to figure out.
Yeah, I mean, the idea behind this is really sort of to help inform, review, kind of get a better handle on an annual basis. You look at tobacco in this particular year, you've had a gain from not being invested in tobacco, but in previous years you've had losses from not being invested in tobacco. So I think this all helps to inform the deeper dive discussion that you have scheduled for 2021. So I haven't got a grasp on, maybe we'll have another look at kind of across the US, sort of, how divestment is analysed by different pension funds. It could be worth having another look at. But I would say, we've got a fair few examples of other asset owners doing this type of exercise.
So if we have a customized benchmark, then it's not necessarily, is it something that has to be reviewed on an annual or 5-year basis or whatever? I mean, we have a customized benchmark anyway, so we have things that we have in our portfolio and things that we don't for various reasons. I know these are direct divestments either by order of the legislature or by the board. So is it the verbiage that makes the difference?
And whether staff wants to make a comment on that.
Yeah, I could say that I believe when the board voted to include this in the divestment policy, it was really out of a desire to just be supportive of the fiduciary duties the board is under, to monitor, since it is an active decision on the part of the board and or the legislature.
Okay, thank you.
Thank you, Mr. Perez.
Keeping in the thought process that we're a long-term investor, we can't really just look at last year, saying that we would have not lost as much money, and over the long term, we would have been a lot more healthy. I don't know if this is because I know this is an information item. Information item. I don't know if it's appropriate to ask the board to vote to lift divestments, or if we can put it on for another meeting.
My recommendation would be, if we want to do that, we should put it on a future agenda item.
Can we do that soonish?
We can do that.
And I know I'm a broken record about that, but as part of the fiduciary duty, that every time this comes up, I have to say it.
Is he, do
Need to vote on what? Will we do a different agenda item at a different time?
oh, he wants it, I'm sorry.
Not today. Right. Correct. Anything else, Mr. Perez?
No, thank you.
Thank you. Ms. Yee.
Thank you, Mr. Chairman. I'm going to sound like a broken record because I keep asking for this, and I don't know if there's a proxy for this, but whether it's now just looking at kind of the review and our duty to monitor this, or the deeper dive that we're going to be doing, probably surrounding Mr. Perez's question, still trying to get a handle on how we look at any potential benefit that CalPERS derive from the reinvestment of the divested funds. And I know Ms. Taylor's question really spoke to, like, what do we do with that money? And, how do we reallocate it? How do we reinvest it? And so is there a way to get a handle on that? I know it's really, because I feel like it's a little bit of an incomplete analysis otherwise.
If I may, so for every dollar we divest, we use that dollar to reinvest back into the global equity portfolio on a pro rata basis. So whatever in the 10,000, as Ms. Taylor pointed out, we have around 10,000 securities in our global equity portfolio. So for every $1 we divested, for example, from tobacco, with the pro rata putting back in the rest of the portfolio. So at least $1 is the opportunity of invest of that $1 or that divested $1 is not lost. We put back in the global equity portfolio.
Hold on, your microphone's off. Go ahead.
So in terms of any benefit we derive, is it appropriate, and I don't know the answer to this, is it appropriate then to track the, I mean, it's impossible because you, I mean, that's the entire global equities portfolio, right?
Right, so in a way, sorry. So these numbers are based on this methodology. So every $1 divested, put
Okay.
back into the portfolio pro rata.
Ms. Yee, maybe I can try that. This is Andrew Junkin with Wilshire. And I came up because I've presented this report for 15 years now. Think of this as really the opportunity cost. So you have taken money out of something, you have reinvested it in this case. And we're comparing those two portfolios, one that happens to be your actual portfolio without tobacco, and one that is the hypothetical portfolio where it was reinvested in tobacco. But the dollars that come out of tobacco are spread right across the rest of the global equity portfolio. We take into consideration rebalancing at the total fund level. We take into consideration the size of the internally managed portfolio, which is where the restriction actually exists and not on external managers. So this is, as close as we can make it, apples to apples to the kind of comparison that I think that you're looking for. Without sort of review mirror kind of driving, well, maybe we should have put it into more, I don't know, technology or whatever. It's just, we just literally eliminated tobacco and everything else gets prorated up by its existing weight.
Okay, all right. And maybe before we do the deep dive around Mr. Perez's question, I may want to revisit kind of what should go into the analysis of our decision around that, because I just want to be clear that, I mean, obviously there are costs and there are benefits, and so just how to appropriately weigh all of that into the economic analysis and financial analysis. Thank you.
Ms. Middleton.
Okay. Thank you, Mr. Chair. And I am somewhat new to this conversation, but it's one that gets an incredible amount of attention. And I think it behooves us to have metrics that are easily explainable to the general public, because there is, in my time on this board already, a considerable amount of, I think, misinformation and even greater misunderstanding as to what we have here. So I'm going to follow up on Ms. Taylor and Ms. Yee. If we divest X dollars from a industry, then there is a restraint on what you are able to invest, but you are taking that money, whatever it was, less the costs of the transactions to get out of that industry, and putting it in the general portfolio. It seems to me the fundamental question is the general portfolio outperforming or underperforming against what this industry was that we divested from. And that should be a fairly straightforward delta question. We took $10 million out of tobacco as an example, and I'm using rough numbers. And over the course of 1 year, 5 years, 20 years, the tobacco returned an investment of a number, and the general portfolio produced another number. What's the difference in those? That still leaves all of the political, social questions that drive divestment decisions and drive interest on those. But we should at least be able to get down to what's that fundamental number. And I'm going through these reports here. I can't get to that simple number that I could take and go to my constituents and say, this is what divestment has produced in terms of a result.
That is effectively with slightly more complicated math to represent the fact that the portfolio is fully diversified, exactly what we've done if you'll go one page forward. And if you wanted to present to constituents the benefit or the decrement to the dollar value of the return of the plan of the divestments, it's on this page. So tobacco, since inception, has cost $3.5 billion to the plan. The plan would have $3.5 billion more dollars today,
Right.
had you not divested.
$3.5 billion more, accounting for what the general portfolio has produced?
Yes.
All right.
Yeah. The one point I do want to make, because I think there's one number on this page that is, it's bothersome to me, and that is the magnitude of the South African divestment. At this point, that divestment has not been active for 25 years.
Right.
And so long as the plan has positive returns, the value of that divestment, the decrement to the dollars that are available to pay benefits will continue to increase to infinity. It could end up in some really, really bizarre, 100 years from now, CalPERS is down to its last 10 beneficiaries. I don't know. I'm just making up a scenario. And you might say, well, South Africa cost us $78 billion, but we've only got $14 left. I mean, there is a scenario. So that number is accurate. I would argue it is. At this point, after 25 years, it's meaningless.
And that begs the question, at what point do we say that the impact of divestment is no longer something that's relevant for us to count?
Yeah, if it were me, I would put a sort of a terminal period. Once a divestment is closed out, so you divest and you reinvest, and that reinvestment closes it out. I would say we're going to measure it for another 10 years, and then it's just done. Because otherwise you will end up with some numbers that, while accurate, are completely meaningless.
All right.
Thank you. Ms. Oliveris.
Thank you. So I think these are great questions about the comparative performance of those securities from which we've divested versus the overall performance of the portfolio. I think it would be very helpful to see this laid out a little bit differently so that we could see the actual back-tested value of those securities from which we divested, right, over the same, like 5-10-year time period, or from whenever that divestment became active, versus the historical performance of the portfolio, and then same time going forward. It's just, the way this is laid out is it's difficult to understand. So that's one comment I want to make. When we get to what other pension plans are doing, I would like to say that there are some peer groups that are doing this, and that would be the insurance industry has done this. And because they are highly regulated, they've had to report on an annual basis. I am not making that recommendation. In fact, I would say that once there's a decision to divest and there are no new divestments, or no new investments into that particular category, then I would think reporting doesn't need to be as frequent. These investments are typically of long duration, sometimes 10 years or more. And so I'm just trying to make sure that as we look at what CalPERS is doing, that we're also looking at what other peers are doing in this space in terms of reporting and then monitoring our investment performance related to those divestments.
I agree that I'm now answering a question that was maybe 5 minutes ago from Ms. Taylor, which is, should we be doing this? Should we be doing this as often as we are? I'm certainly not your fiduciary counsel, but I believe it's your duty as fiduciaries to the plan to monitor this on a regular basis, because it is, whether it's forced upon you or whether it's your choice, it's an active decision. And you can change, in some cases, your mind. You can't on Iran and Sudan. But you could reinvest in tobacco. The board chose not to do that 2 years ago. Weighing all of the evidence at hand, and so I'm not rendering a judgment on that. I'm just saying I think that's the kind of process, as painful and as long as that process was on a single divestment, that, quite frankly, is the process that you need to go through on all of these on a regular basis to reaffirm, yes, we want to stay out of that. In terms of presenting things more simply, I'm all for that feedback. This used to be about a 23-page Word report that we tried to simplify about 3 years ago and think we got better, but happy to take feedback on how it can be more useful to you or to the general public. There is absolutely no pride of authorship here. We just need to present accurate numbers to you.
Thank you. And then on South Africa, so the active dates for that divestment was up until what, for Q4 '94. I'm trying to understand how we are calculating the loss here or the comparative performance relative to the perf. I don't even know the durations on these investments. So it's possible that some of these could have had a 10-year duration or less. And so I don't know how we would project out that comparative performance.
So pretty simple. You divested of South Africa during apartheid. Apartheid fell, you reinvested, you lost money while you were out. That opportunity cost compounds at the rate of growth of the total plan.
So you're just carrying it forward. You're not looking at how that actual investment is doing now, or if it's, okay.
Right. Which is why that, to me, it's, I understand the magnitude of the number, but that's a decision that was originally made, I'm going to have to do math, and this is not my strong suit, 31 years ago.
Yeah.
And finished 25 years ago.
That was pretty good on the spot.
Thank you. On the fly. Let the record reflect. But that is exactly, and if you look at some of these tables, these are the open investments. Yeah. You can kind of dig in and see, all right, here's global equity, X tobacco, I'm on page 6, global equity, actual, and so the net difference, and then we just sort of multiply on a monthly or quarterly basis what was the value of the portfolio, what was the difference in the value of those returns, what does that turn into in dollars, and then we cumulatively calculate that over time. But then it's also scaled, the closed ones are scaled for the total fund return. We also, in the old analysis, and this is one of the reasons it was 25 pages, we did it by CPI, but that wasn't a real number because the opportunity cost actually lost at the total fund level. We also did it at the global equity level, and then the numbers were wrong but too big because global equities obviously had been the best performing asset class in the portfolio over that time period. So it was growing at too fast a rate.
Yeah, I think it would be helpful to get, I mean, again, if we have another conversation on this, more clarity around this process as, there's not perfect information here at all. So I see that a lot of assumptions have been made, but I could also see how this could create a very high divestment cost, particularly when it comes to South Africa. That's not based on what the actual numbers would have been.
Did you look up the actual number before we came back out?
I did. I'll have to pull that out.
Yeah, we've got the actual closed cost of South Africa that doesn't continue to grow for 25 more years, so we could bring that back.
Thank you.
Mr. Jones.
Yeah, thank you, Mr. Chair. Yeah, I think you kind of answered my question in responding to Ms. Oliveira's question. But looking at tobacco, for example, the $3.5 billion, $3.6 billion, when we divested, that was, say, a number of $100 million. And just like the South Africa has tended to grow, as the PERF fund grows, the tobacco is going to grow. That 100 million is growing based on the growth of our total portfolio. Is that correct?
Well, tobacco is still open, and so the gap narrowed. If you look at this page, in fact, in the cumulative present value impact, the next to the last column on the right, and you follow across 2017, it was 3.9 billion just 2 years ago. And because the portfolio, because essentially tobacco underperformed the rest of the portfolio and you didn't own it, you benefited by not owning it over the past 2 years or year and a half. And so that gap narrowed from 3.9 billion to 3.6 billion. So that's, that's one of the issues, and you see it more with some of the shorter term divestments. Where's coal?
Coal at the back.
Coal, it could go either way. You're either right or you're wrong by divesting of an industry. And it could actually add to the returns, or it could, as has been the case, detract, at least in tobacco. This also goes to CalPERS investment beliefs about engagement over divestment. You can't engage with a company that you don't own. You've lost your vote, right? You've lost your seat at the table.
Mr. Chair, if I may say something, so this is related to, this is a deeper question, a little bit philosophical. So we focus on the outcome. We made an investment decision, let it be divestment in tobacco, or this morning, to Controller Yi's question, the private market investment policy, what is the top quartile based on the past performance again. In the course of our professional life, we make a number of investment decisions. Some of them turn out to be good, some turn out to be quote-unquote bad, if you only just judge on the outcome. But if you recall in my January offsite presentation, I took lines, discuss about the skill and the luck component. So in hindsight, to judge the investment decision purely by the investment outcome is not really a fair game for the investment professionals. What we really should be looking at is, when we made this active investment decision, what was our belief? We believed in A, B, and C. And because we believe in A, B, and C, we thought tobacco would underperform financially. And now fast forward, after 20 years or 10 years, for the past 2 years period, it seems like divestment in tobacco paid off. But look at the entire period, it didn't pay off. But again, we are still focused on outcome only. So if we went back to the reason we believe in tobacco would underperform, because again, I just threw something hypothetical out there, because we believe the generational trend, or the younger generation would not subject themselves to the addiction to tobacco. If that was a belief, and back then we also believed that the valuation back then had not fully reflected that belief, we divested. Now 10 or 20 years ago, we should analyze the underlying thesis, why we believed tobacco would underperform. Were the reasons right or wrong, or would it still continue to be there? Otherwise, we keep on going back to chasing the tail of it, looking at either the outperformance or underperformance, and try to use that outcome to judge the investment decision previously is not constructive, is not fair to the investment professionals. So I really encourage, it's similar to the discussion this morning, top quartile selecting private equity managers. The performance is the symptom, not the cause. We would like to understand the cause, the underlying driving factors, and are these factors still here going forward or not? So that's my 2 cents of a caution, a little bit philosophical. I know the performance, the outcome, hindsight is 2020, and the outcome performance, black and white, a number right there, either you outperform or underperform. It's very convenient for us to grab to that number, right? But we really need to ask another question layer below the performance. What caused it? And more important, what was our belief? Why did we make that investment decision? Are these reasons still valid today and going forward?
Anything else, Mr. Jones?
No, I agree with Mr.
Thank you, Ms. Ortega.
Thank you, Mr. Chair. Mr. Meng made largely the point that I wanted to make, which thankfully, because I'm sure he did it much better than I would. I think this conversation is very interesting and helpful in the context of the continued discussion we have before the board and the public comment we get about fossil fuel divestment. And what I think about is the sort of what I see as an overly simplistic way of looking at divestment when we just look at this outcome and not what was considered at the time. And certainly what I feel like we're missing when we talk about tobacco is at the time that the decision was made, there was an analysis of risk of that investment too. And so we don't see the balance in the discussion here. We just say, well, we divested and this is the outcome. But at the moment, there was a belief that there was a risk to continue to be in that in those investments. And that's the way I think about the fossil fuel issue. And all of the risk we have in the portfolio around climate is we may come to a point where we're making investment decisions, but how do we get to the appropriate analysis of the risk that we would be considering? And the conversation that's come up, the words that have been used numerous times on opportunity cost. And so, again, we have this report where we talk about these 6 categories of opportunity cost, but every investment decision that's made is an opportunity cost. And we don't have a report that lists every real estate investment choice and the trade-offs, and if we had purchased this other property instead, what would we have had? We're not taking that same kind of look at every aspect of the portfolio, and my sense of that is because we have policy that guides those decisions. We have direction to the staff about the appropriate level of risk to take, the mix of the portfolio that we have an expectation to have. So we don't call that before us to do that level of review. So again, going back to opportunity costs and having policy that directs that, it goes back to what our fiduciary duty is, which is to have appropriate process, to be able to say that we used a process that considered all of the risks and all of the information that we knew at the time, and connecting that back to the questions about climate risk and some of the fossil fuel investments. What I don't have a good sense of right now is how this board is going to have a process going forward to analyze those risks, to take those considerations into place, notwithstanding what we heard from the earlier presentation related to the report to the legislature. It still feels to me that we're missing that. How would we go about making decisions about addressing that risk going forward? Thank you.
Mr. Miller.
Yeah, I think Ms. Ortega really hit on a lot of what I wanted to talk about. What I fear is that we kind of devolve into, as a board, trying to micromanage individual investment decisions and investments on a more frequent scale than even we would have envisioned with our 5-year review of these divestment decisions. Seems to me to be a good time frame. We're in the middle of that with some of them. Others are coming up. That seems like a reasonable time frame to be doing a look back and see, not so much for purposes of saying, oh, should we be jumping in and managing these individual investments out of 10,000 of them, because on almost any one of them, I might think, we should invest, we shouldn't have done this, and we should have done this, and instead of doing this with the money, we should have done something else. But it's a diversified portfolio. We really, even the investment staff, that's not what they're doing. And so it seems like this idea, let's jump in before the 5 years up and start revisiting these things on a different schedule and assigning staff to bring a bunch more stuff back and have a discussion about tobacco rather than wait till we get to the point where we had scheduled to review that. And thinking about, why are we reviewing it? We're reviewing it so we understand the impact. We're reviewing it so maybe there's some lessons learned for our decision-making process, our assumptions, things we can learn going forward. But I wouldn't look at it as we're reviewing it so that we can take this specific investment and start micromanaging it at the board level now. And that's kind of the sense I'm kind of getting, that we could end up heading that direction the way we're thinking about things sometimes. And when it comes to this cumulative impact, I do think we really should be thinking about how do we look at that and what do we do? Because, as you said, if there's nothing but the costs of getting rid of something, and then the next year we jump right back into it, that cumulative loss is just going to keep on compounding. You know, it's a limit at infinity over time, as was mentioned, and it's not useful information. It's not anything you can use in a practical way for decision-making. It can only be used if there's a misunderstanding about what it means, and people are thinking, oh my God, look how much we're losing because we've divested, we have to jump back into that. When the reality of current performance in a divested, diverse portfolio doesn't indicate that at all. So I just caution us as a board that if we want more understanding and clarification of the impacts of these things, that's great, but I don't want us to be prematurely or more frequently second-guessing our own decisions.
Thank you. Mr. Perez.
I have to respectfully disagree with Mr. Miller. We're not micromanaging. We put this constraint on you. The last time this was discussed in March, I had asked if the staff, if the investment team wanted to be in it, and they said yes. I don't know if that still rings true today. And I'm not saying that we just jump in and put 1% of the fund back into it. I want the staff to be able to develop a strategy, and whether they think it's valuable to be in it, then they should, and if not, then they don't. All I want is to lift the divestment. On the other divestments, when there's when we get direction from the government, from the governor's office, that's not. I think I understand it correctly. It doesn't say you shall at all costs divest. What does it say? What is the spirit behind it?
Mr. Perez, yeah, are you asking about the governor's executive order that he issued recently that would apply to CalPERS and CalSTRS? No, he is not, it's not an executive order to divest. He doesn't carry the fiduciary duty that you all carry as the 13 members of this board, but it is a request to look into greener investments than what we would have with fossil fuels. So we will work with Department of Finance. We've already had one meeting with them. We'll continue to work with them on identifying a framework where we think the governor could have an impact for the state of California, realizing that we need to continue to work with this board on our ESG 5-year plan that's already in place.
So if the state would say, go green, if the state would give us that money that we projected to return, then I would say, okay, because then that's a solid return. We're always going to have that. But to say anything more is kind of irresponsible. We do have a fiduciary duty. And lastly, Mr. Chair, I would like, when we do bring this back up, if we can have a prudent person opinion on the matter.
All right, we'll add it to the notes.
Please, thank you.
And Ms. Crocker, could you, I think you mentioned the 2021 date for the full review of current divestments from the team?
Yeah, that's correct.
Okay. And then just one other response to Ms. Ortega's question. So at the time that a divestment decision is made, there's a full analysis of long-term risk that is communicated with the board. We did that in December of 2016, and I can get that analysis to you so you could see, anticipate really what the team would be bringing back as a part of this review.
Ms. Oliveros.
Thank you. I think it would be helpful to see the stranded asset risk context around some of these divestments, because I think that's behind the decisions that were made to divest, or at least that's my hope that was considered. So the business model risk, political risk, and legal risk. That way we understand what the financial risks were at that time. So if we could just even have a little bit of context in the report, I think that would help us understand.
Thank you. Ms. Middleton.
Okay. Thank you, Mr. Chair. As we get into a deeper dive into the subject, one of the things that I particularly want to get more information on is when organizations such as ourselves divest from an industry or divest from a certain organization or country, what is the impact on the behavior of those organizations? If we get out of coal, as an example, does that make any difference in terms of how coal companies are operating their businesses? Are we actually producing a positive impact by our investment divestment decisions, or are we not?
Okay, very good, thank you. Seeing no other requests to speak, I do one request from the audience. Derek Lennox. You have up to 3 minutes for your comments. Please identify yourself for the record.
Thank you, Chair and members. Derek Lennox on behalf of the Association of California School Administrators. For those of you who don't know ACSA, ACSA represents retired and active educators, mostly active from across the state, 18,000 members. I say retired, of course, because I would say that's our group that has the most to say about some of the social, environmental, and governance issues that are addressed in a lot of our divestment conversation, ESG conversation. But on the other side, we represent folks who are active members as well that expect to have their retirement there when they get to that point, and that are also our business partners here at CalPERS to make sure that the contributions can be paid and that the contributions are manageable on that side. So I do appreciate the report, and actually the comments that were made about some of what goes into it are really interesting comments. A lot of it looking retrospectively at the divestments that have occurred already. The perspective that I want to bring about why this report is so important to us is actually prospective. And the reason is because, you know, with us being 68% funded on the school side, when we have these conversations in the legislature and with policymakers about divestment, having this information about the impacts to date is really helpful. And again, there's nuance to it, but just to show the overall impact really makes a big difference when we're trying to explain that we have a larger priority here, which is to protect the defined benefit system, and so that any sort of micromanaging, I mean, you know, you guys are the board, but to have people micromanaging from outside of this building is not something that we want to see as school employers and public agencies. So I would just reiterate many of the comments that you have all made, which is to focus on the risk-adjusted returns and to maximize those and to take into account the risks that you all are talking about here today, including climate change, including fossil fuel use, including governance issues, but to have that be a staff and board decision, not something that happens from across the street. So in that sense, it's a prospective concern that this report raises, and it's very helpful as we have these conversations during the legislative year. Thank you.
Thank you. What other requests for Dr. Robert Gerling? Again, you'll have up to 3 minutes for your comments, and identify yourself for the record, please.
Good morning. My name is Robert Gerling. I'm a professor emeritus from the School of Business at Sonoma State University. I'm also a retired member of CalPERS. I'm the legislative representative for the CSU Emeritus and Retired Faculty and Staff Association. So I wanted, first of all, to thank the board for the very thoughtful questions on this last item. I thought that it really clarified things to me in terms of your thinking, and frankly, you know, the report that was presented raised more questions in my mind than it answered, and so the line of questioning that you had was to ask for a much more a clearer report, something that I can take back to my members, and that would be very helpful. In relation to that, one thought that I had was this item draws in part on data from item 6G, the 2019 California Public Divestment from Iran Act and Sudan Act legislative report. which contained company-by-company data on the risks associated with a wide range of investments. So that's this report right here. And as you look through that, you'll see that it discusses a number of specific companies. Now, my thought is that it would be quite helpful in the revisions that the PERS staff does to the report on SB 964, that they might follow this kind of methodology in examining and looking at the risks, especially the Scope 3 risks associated with 80 major companies responsible for 50% of the greenhouse gas emissions. So I think that sort of granular data would prove very helpful to the committee, the board, excuse me, in terms of making decisions that minimize risk. So that's my thought on that. Again, thank you for all that you do on behalf of our members, and your work in terms of balancing the short-term risks and the long-term risks. And with regard to long-term risks, I just want to say one thing, which is that climate risk is something that has affected my campus severely. It was closed for a week. The president of my university, her house burned down. And when I went in to talk to her a couple months ago, she spent an entire hour just talking to me about the effect that had on her family and her inability to perform her duties to the best of her ability. So I think that this issue of climate risk is something that affects us all. We lost power. Many people in my neighborhood did, and I appreciate the fact that you're looking very carefully at these issues and thoughtfully. And my association stands ready to help in any way that we can in terms of analysis or whatever. So thank you again for all that you do.
Thank you. Brings us to agenda item 9, the Investment Education Workshop. Mr. Meng.
Yes, Mr. Chair. As I said in the opening remarks, this is the last of the fall board education series. So today we have the honor to have, my colleague Ann Simpson, and then, yes, please. And we have, as you know, in past 3 workshops, we have been working with the CFA Institute. And for the last topic, unfortunately, CFA does not have a readily available speaker. So instead, we have, I will turn over to Ann Simpson, who will do a proper introduction of the speaker.
Thank you very much, Ben. Well, a warm welcome to Vaughn Hughes, who's joining us to round off this year's first program on education for the Investment Committee. I think the board can feel very proud that some wonderful work came out of the self-evaluation that you completed with NACD, and the work stream led by Teresa Taylor and Mona Pasquill-Rogers was focused on education needs. So as we were racing to get the complete curriculum finished, as Ben said, CFA and CII, who've been our partners, weren't able to pull people out of their holiday celebrations and boiling of Christmas puddings and things that keep people busy at this time of the year. So they did recommend that we speak to Vaughn, who we knew already because he's just published what I think is the first handbook for U.S. public pension fund trustees. So Vaughn comes to us highly recommended, both through his recent publication and also through our friends at CFA and CII. He's also, I think, well qualified to share his understanding of private markets because of a wide range of experience that he's had over many years, and you can see it in his biography. But in addition to his stellar experience and academic achievements, he's also a trustee of the Greenwich Roundtable, which is a non-profit organization that focuses on private markets, or what sometimes get called alternative investments. But that suggests everything is an alternative to the public markets. And for CalPERS, we're a little more balanced. The public and the private markets are both extremely important. So we have time today for Vaughn to go through the slides. I'm also glad to say Ben will be here to give us wise advice on how the issues for the private markets roll out for CalPERS. And also, we have the leaders from CalPERS private asset classes here available to answer questions as well. That's Greg Ruiz and Sarah Kors from private equity, Jean Zhu on private credit, and Paul Michaka from our real assets private markets class. So we encourage you, as before, to ask questions or make comments as we go through. Hopefully you've had a chance to browse through the presentation so you know what's coming from one stage to the next. But let me, with that, give Vaughn a very warm thanks from everyone here for being willing to give up his time, not just to be with us here today, to travel out from the East Coast, which is in itself time and effort, but also for all the work that goes into preparing something like this. As the board knows, all of this material will be loaded up onto the new Insight tool, which Tim Taylor and friends are building as we speak, another work stream from the board governance self-evaluation. So whatever Vaughn is able to share with us this morning will be something that you can return to in the future when you want to refresh your thinking about the importance of private markets for CalPERS' ability to achieve its investment target returns. So with that, Vaughn, a warm welcome, and we're looking forward very much to hearing what you're here to share with us.
Thank you. Again, my name is Vaughn Hughes. I'm a partner at PAMCO Prisma. I've been at the firm for about 16 years. I'm actually here in my own capacity, obviously. Some of the research from the book driving the conversation here. I head up our firm's strategic advisory effort, and I personally focus on public pension plan policy and governance. My full bio, for those who are interested, is on page 2 of the presentation, but before I begin, I really wanted to thank the board and the investment staff for inviting me to participate in this discussion on private markets. Now, to be fair, private markets is a very big topic. Any one of the concepts that pop up today could probably warrant their own educational session. So with that in mind, I really just tried to provide a presentation that provided a general overview of private markets. And turning your attention specifically to page 3 of the presentation, maybe back, yeah. I just wanted to go through an overview of what I'll talk about. I'll talk about the differences between public and private markets, really highlighting the defining characteristics of the latter. I'll talk about the benefits of investing in private markets, why public pensions do it, what are the risks. I'll also provide a snapshot of the global private marketplace in aggregate. And then I'll finally delve into some of the major private market segments, obviously private equity, real assets, and private debt. It's kind of funny. A funny thing happens when you write a 500 book about public pensions. People think you know everything about public pensions in their portfolios. However, I do not. And I very much look forward to leaning on the expertise of the staff that's in the room today that live in these markets to answer any questions that might specifically touch upon the CalPERS portfolio. Now, where my research might be helpful is that I've tried to really infuse this presentation with the perspective of how public pensions in particular participate in private markets, where that data was indeed available. Any questions you have that I can't answer, I'll work with Ann to make sure I can follow up and add as an appendix for later viewing. So with that, turning to page 5, to better understand private markets, it's obviously good to touch upon public markets. Public markets typically refer to a market where the general public can buy, sell, or trade on a public exchange, and there are about 60 major public exchanges in the world, managing about $69 trillion in publicly traded securities. New York Stock Exchange and NASDAQ are great examples. They're the 2 largest exchanges globally. Companies that choose to go public do so really by registering with the financial authority, the SEC in the U.S., and by virtue of this, they're allowed to raise capital from the general public. But in exchange, they also have to comply with disclosure requirements and exchange-specific rules. For most of the 20th century, retail investors were the main capital provided on these exchanges. As you move towards the end and through the end of the 20th century, institutional investors, like public pensions, became larger and became larger players in the public markets. And in fact, it's really around these institutional investors, the sophisticated investor, that private markets developed. Turning to page 6. So what is a private market? Well, first and foremost, it's not a public market. It's not open to all investors. The general idea is that the SEC decided that investing in certain securities required a skill, an investment skill, that would put the average retail investor at a disadvantage. So it decided to limit the access to private markets to accredited investors. And this is defined by Regulation D. Accredited investors are typically institutional or high net worth individuals, with institutions being banks, insurance companies, large firms, benefit plans, trusts, and other financial institutions. And it's really only these investors that generally participate in private markets. A lot of regulation, no need to get in here, that are really opening up the doors a little bit more, but suffice it to say that that's probably the best way to look at it. Turning to page 7. Compared to public markets, private markets have some defining characteristics. The first is that private markets are less heavily regulated than public markets. They are regulated, and they are regulated by financial institutions, but they're just not subject to the same degree of disclosure requirements and exchange-specific rules. Second, private market reporting requirements are limited, and this really has led to people to talk about private markets as being more opaque or less transparent, but we'll talk about that a little bit later because that's not always the case. Third, private market valuation of securities are established at a point in time, not continuously as in public markets with supply and demand. And finally, public markets are illiquid. Hard to sell because there's not a market for ready buyers, and any number of reasons. And private market securities are hard to sell or illiquid. And the key concept here is that without a lack of ready buyers, if you want to sell a private market security, the price might be adversely affected. And really because of this, investors in private markets, investors in illiquid securities have sought an additional level of return. And this additional level of return to compensate for the illiquidity risk is called an illiquidity premium, which we'll come back to. Turning to page 9. So why invest in private markets? The fundamental reason is to gain return greater than can be found in public markets. And for public pensions specifically, this must be read within the context of the defined benefit liability gap. The average public pension is about 70% funded and has returned about 5.6% since 2000. And however, most assumed rate of returns average somewhere between 7.5% to 8%. So long-term public pension liabilities are increasing, and public pensions are turning to private markets to help close that gap. Private market return can come from many things. The illiquidity premium, which we talked about, active management, investment focus, investment selection, operational efficiencies generated primarily in private equity, and just skill in structuring and negotiation. There's also the GP-LP alignment with fee structures that really do incentivize for GPs to generate performance for their LPs. But beyond performance, there are also a number of reasons why to invest in private markets. There's a risk reduction feature. Without the mark-to-market requirements of public securities, private market, including private market securities in a public pension, can lower volatility. I also think that in some cases, private securities can offer more transparency and more oversight into an investment because an institutional investor is usually one or only one of a few investors in the security, and that's a unique position to be in. In general, the characteristics of the private market, the long-term horizon of investments is consistent with the public plan's long-term goals. And something that we'll talk about shortly, and that is with the rapid increase of private markets, In order for public pensions to gain exposure to broadly diversified global growth, accessing these private markets beyond the public markets is actually important. Now, there's some things to consider when investing in private markets. High fees. It's an expensive place to play. Management fees and performance fee can dilute from performance. In fact, a 2018 study found that, specifically dealing with public pension expense ratios for PE, found it the highest at 136 bips. Followed by real estate at 89, and you actually can compare that to domestic public equities at 21. So it isn't expensive. I would argue that the most important thing is to focus on net performance, and in that regards, many of these assets still outperform. Second, the market is illiquid. It is illiquid. The flip side of the illiquidity premium is the simple fact that if you want to sell, you might not have a market of ready buyers, and that could adversely affect selling, or definitely might require a steep discount to some of the assets. And the GP alignment, although it's pretty much there for performance, there are certain circumstances where GP and LP interests can diverge, usually around the end of an investment period. So that's something to be aware of too. And finally, private markets are highly, highly talent dependent. The dispersion of returns for managers within the private market compared to the public market is just far wider. There was one Morningstar report that looked at PE performance from 2013 to 2018 and saw manager performance from down -30 to up 40%. And that study actually compared the return dispersion of U.S. domestic equities, and it was only between 5 and 12%. So manager selection is paramount in private markets. Turning to the next page, this is a simple slide that just lists out the major private market segments: PE, real estate, private debt. We're going to talk a little bit more about the overall market, but then we'll touch upon these segments by diving deeper. But turning to page 12, the total size of global private markets is $5.8 trillion. The chart on the left, it shows private market assets broken down by market segment and geography. The chart on the right shows the relative size of each major market segment to the global market. And what strikes you immediately and what you can take away from this is PE accounts for over half of total private markets, 59%, representing approximately $3.3 trillion. Real assets accounts for 28%, or $1.6 trillion. And private debt accounts for 13%, or about $800 billion. And in comparison, total public equities amounts to about $70 trillion, to give you a relative size of the market we're dealing with here, and total public corporate debt is around $12 trillion. On page 13, private markets have grown dramatically in recent years. Cumulative fundraising has more than tripled since 2006. Fundraising has grown steadily at 7.8% annually since 2013. And this has really been driven by mega funds, or funds $5 billion to $10 billion. And they've accounted for almost a third of all fundraising in 2008, which is actually double what they accounted for 3 years ago. Private equity drives private market growth at 7% annually. One thing I will mention is that private equity is the only market segment that in the last year has actually had a lower growth rate. Real estate, with this 4% growth, that's a teeny bit misleading because it excludes direct investments, separate accounts, and other open-ended funds that have done well. And I did want to mention one thing that stands out. It's the recent growth of infrastructure at 10% annually since 2013 and 17.2% since 2017 and 2018. McKinsey wrote a report recently that estimated that nearly $4 trillion in annual infrastructure investment will have to be made globally to keep up, and this is through 2035, to keep up with global growth. I just want to highlight that what this represents is going to be a persistent funding gap, and I do believe that'll provide some opportunities, particularly in in infrastructure investing going forward. Turning to page 14, dry powder. That's the capital available for GPs to deploy. In other words, it's committed LP capital that remains uninvested, and it's often looked at as a proxy for the health of the market. The chart here shows the growth of dry powder in private markets since 2000, and it's grown to a record high of over $2 trillion in 2018. It's grown at a strong 13.6 fundraising rate since 2012. But you really have to step back and kind of interpret what this really means. Well, on one hand, it means a strong demand for exposure to private markets and the likely continued growth of this marketplace. On the other hand, it might represent that there's pressure in the system. In fact, some people talk about a dry powder problem, where GPs can raise a lot of money, but have insufficient deal flow to really put that money to work. And that can lead them to invest in lower quality ideas or overpay. With increased competition in the marketplace, multiple valuations are getting high. Some even talk about a private market bubble, pointing to some market conditions today that look like 2007. It's just my opinion, but I believe today is very different today than 2007. The people who do point to 2007 see similar high deal volumes, see similar high valuations and covenant-light lending. But today, the market in private securities is just far more mature. It's twice as large. It's more liquid. Sellers have more options. There's lower leverage in general in the marketplace. And honestly, investors are just more savvy in the space. They're committed to the space and willing to play through market downturns, even finding value in that space. One thing I do know is that private markets will continue to grow. On this page is a BlackRock Institutional Investor Survey, and it shows that even with high levels of dry powder, institutional investors are going to remain bullish on private markets. The greatest expected increases are in private equity and real assets, and with this primarily coming from a decreasing traditional equities, and for that matter, fixed income, but mostly equities. And finally, looking at public pension specifically, public pension demand for private securities is likely to remain. As this chart points out, on average, public pension allocations are under their target weight across all private market segments. Public pensions are closest to their target allocations in private equity and real estate, but furthest from their private allocations, their target allocations in private debt. So you really see this being behind the demand, the continued demand for private markets by public pensions. So turning to page 19, maybe I'll pause here and ask any questions about public markets in general before I delve into specifically the market segments for a bit.
Ms. Brown?
Thank you. Let me go back to my note. Hold on. It was with your slide 9.
Sure.
So let me first start out by saying, admittedly, I can't match your Ivy League education.
Just a lot of school debt.
And I have a UC education, and I have advanced degrees from the School of Hard Knocks. And but it did draw my attention on that slide when you said that private markets have risk reduction. And you talked a little bit about more transparency in the GPLP framework, and we don't see that. I don't think we see that. And more oversight. We want more oversight. I don't know that we're getting more oversight or more peeks into it. So I'm just wondering, since you're the PhD here, tell me what data you have that supports this risk reduction in private markets.
Well, I'll say it in two ways. One, there's the mathematics behind the simple fact that without having...
I can do math.
Right,
okay.
Without having to mark private securities as often as public securities, you don't have a change in valuation, so that reduces volatility if those securities are in the portfolio. But I think, and this is something that gets overlooked, is that because you're an only investor in a security very often in the private market, you have an insight and a direct access to a lot of information directly from the company that you just would not get by simply being a shareholder in a public entity. And I think it's precisely with large public plans that begin to build out their resources and have staff to really engage with the companies that they're investing, as will come up later, either with managers and through commingled funds or directly, really have an opportunity to take advantage of the information that is actually out there that is well ahead of what could be offered by simply buying shares in a company, for example.
Yeah, Mr. Meng, how many times are we the only investor?
I don't know the exact number. We are the only investor. In some of the separate manager accounts, so we are the only investor into account, but that account invests in other companies in partnership with other investors. What I would like to say something about the risk reduction, as Mr. Hughes said, that if you look at private markets, the risk reduction comes, in my mind, comes with two sources of it. Exactly as Mr. Hughes just mentioned, that the manager selection in private market is of paramount importance. You have to have access to the top managers. And why we have such a strong belief in the top managers, because we believe in their active management skills to generate with something we call alpha. Alpha means on top of the market beta can give you. So the alpha normally comes with what we call idiosyncratic risk. But if you build a portfolio of different private equity deals, for example, the idiosyncratic risk comes with the additional alpha. They are diversifiable. Means that the more larger portfolio you build, the alpha component by construction is orthogonal or not correlated with the beta components and not correlated with each other. So it means that the fact of portfolio diversification helps you to reduce the idiosyncratic risk that the skillful manager brings to the portfolio without sacrificing the additional return. So that's one aspect of the risk reduction from a private market. And the other aspect, as Mr. Hughes pointed out very elegantly, that in private markets, since it's that private, not traded on an exchange, so they are marked, the reporting less frequently. The valuation is really based on a model valuation, not really a market transaction. And many times the valuation is delayed, so not timely valuation. So when it's not a timely valuation, it provides a timing diversification as well. So the risk reduction from private markets really coming from two folds. One is the alpha components, is diversifiable idiosyncratic risk, and the other one is on beta part, is the valuation, the marking is less frequent and is marked based on a model, appraisal based, not so much so about a market transaction based. So that's the benefit of private market. You see the higher return without the commensurable higher risk, because the higher risk comes with can be diversified away if you build large enough a portfolio.
Thank you for that explanation. I would want to eventually have a conversation with you about valuation in the private markets, and since the managers get paid on that assets under management, it behooves them to have greater valuation.
So,
and I know we have ways of checking on that, but we can have that conversation later.
Yeah. For that conversation, I may have to go back to school, get another PhD.
Yeah.
Mr. Rubalcaba.
Thank you. I appreciate the discussion. My question was also about the risk reduction, so I appreciate the low insights. Thank you. I'm good. Thank you.
Thank you. Okay, please continue on.
Sure. So turning to the individual market segments, and these are major market segments, let's first start talking about private equity. And I've obviously touched upon many of these potential benefits and risks when I talked about the broader private markets, so I'll tread lightly. We've discussed enhanced return through a liquidity premium, through active management, through GP-LP alignment, and we're going to talk specifically about the performance of private equity shortly. We touched upon risk reduction. I think for PE, in particular, it provides equity correlation, high equity correlation, in fact, without the short-term volatility, which we were discussing. There's diversification alignment with public pension goals. I did want to touch upon some of the risks. Liquidity risk, again, the flip side of the illiquidity premium. I put funding risk here. It's really a GP concern, but I think LPs still must be sensitive to the impact of capital calls, market risk, general and specific, and capital risk. Turning to private equity returns, it's clear private equity has been the best performing asset class for public pensions. The chart on the left shows that PE has generated an annual return of 10.2% over the last 10 years, outperforming public equities at 8.5 and fixed income at 4.8. In fact, looking at the chart on the right, private equity has outperformed all public pension asset classes from, I think it's 98 to 2017, except for listed REITs on a net basis. I did one, it's not in here, but it's hard to talk about performance of PE, or for that matter, the private markets in general, without at least touching upon benchmarking. Benchmarking for traditional asset classes is done by comparing performance to some investable public index that arguably accurately reflects the market segment or the asset class. Given that private markets strive to outperform public markets, usually picking a public index for private markets, is insufficient. And in fact, benchmarking for private markets is very difficult. Many investors will come up with custom approaches to benchmarking as a way to deal with this. In fact, some of the research on, in particular, public pension PE benchmarks found that 60% of public pensions use some general public equities benchmark, with the majority of those then adding some premium to that. And the research that I found saw that those premiums range from 1% to 5% on top of a public index, with the average being about 3%. So I think with that regard, CalPERS' existing custom benchmark is well within what's normally done by public pensions. Turning to page 21, this page is really meant to be a leave behind, like many of the other pages that look like this. It's obviously a little too detailed. It highlights the major types of PE investment styles, and I'll touch upon each briefly. Buyout funds are the largest segment within PE, and this is only likely to continue. A recent study of public pensions by Preqin found that 70% of public pensions plan on increasing their allocation or actually investing in buyout funds in the next 12 months. A buyout fund focuses on the acquisition of controlling interest in companies. When a management makes the acquisition, it's a management buyout. When excessive amounts or extensive amounts of debt are used, it's an LBO. And buyout funds typically target mature companies, or very mature companies. Compared to growth or expansion funds, these target mature companies as well. Usually the companies that are looking to build out operations in some way, restructuring, acquisitions, entering a new market. Growth and expansion funds do not take majority stakes. They typically take minority stakes. And they're targeting companies less capable of raising money or debt because of either existing debt level or low earnings. Credit related we'll talk about under private debt. Opportunistic are investing in assets where the owners are motivated sellers. And there are few willing buyers. It's usually based on some kind of price dislocation that has nothing to do with fundamental value. And assets here can be bought at substantial discounts and are often sometimes contrarian in their approach. Venture capital invest in small emerging companies, plain and simple, with no track record. And the trade-off for that is you're picking companies that you think have a high growth potential. The goal is outsized returns and ability to exit successfully. I did want to spend a little time on the next two pages, because this is not only a proxy for how you invest in private equity, but really how you access private markets and generally from a structural point of view. Again, this page was meant to be a leave behind, but I'll walk through it as well. Commingled funds are the most common approach to investing in private equity and private markets in general. Commingled funds are funds that consist of assets from various investors, LPs or limited partners, and are professionally managed by a GP or general partner. They're often called pooled investment vehicles because it's pooling all LP capital together, and each LP's exposure is limited to the money they put into the fund. Separately managed accounts are typically for much larger investments, and it's an account owned by a single investor overseen by a professional money manager or sub-advisor. Greater ability to customize, greater control, liquidity, and governance with these. Also higher fees, higher setup costs, and in some sense, more due diligence and active oversight are necessary.
Generally speaking, yes. So on separate management accounts, the fee tend to be higher. The setup fee definitely is higher because we are setting up a separate manager account just for us. So we have to eat, quote unquote, eat all the setup fee. In the commingled fund, the setup fee can be spread out by all the investors. But in our experience, again, because of our size and brand, we haven't been able to set up some separate manager accounts as a fee can be lower. So it does not necessarily mean the fee has always been higher in separate managed account.
That's actually a very good point, because the larger the investment gets, most managers are willing to discount their fees. So you are dealing with fees that can very often be substantially lower than commingled fund investments.
So that shows our size advantage.
Yeah. Turning to co-investments, and co-investments, direct investments are actually pretty interesting. Co-investment is an investment made into an opportunity, an asset, or a company that's made alongside a financial sponsor. The investor investing alongside the financial sponsor is typically an LP in a fund that the financial sponsor is already a GP. So it's really this pre-existing GP-LP relationship that distinguishes co-investments from direct investments. The real benefit of co-investments is that the co-investor rarely pays a management or performance fee for this individual investment. And co-investments can offer enhanced returns that could also provide a cost-effective way to scaling PE allocations, added control over capital deployment, and can also just create a stronger relationship with your GP. What's interesting is because of the benefits of co-investing, the demand for co-investing vastly outstrips supply at this point. And that demand is so high that you now have fund-to-funds, secondary funds, and even dedicated co-investment funds beginning to play more in this space. Unfortunately, demand is so high that many people are beginning to point to a time when fee-free co-investments are going to become increasingly difficult to find. And in fact, it's definitely today that managers are beginning to charge smaller fees for co-investment opportunities. Turning to direct investments, these are investments made directly into a company, asset, or a firm, not through a fund, not side by side a financial sponsor. The institutional investor owns the deal, owns all the benefit, and assumes all of the risk. It requires the greatest amount of resource commitment, but that's in exchange for potentially the highest amount of return. I will also say that direct investments, like co-investments, is a recent trend. With a lot of institutional investors, and particularly public pension plans, building internal staff to actually execute on direct and co-investment strategies. The biggest challenge facing public pensions are governance constraints and resource constraints. In order to do this well, and it happens more often in real estate than private equity, you really have to commit a substantial amount to talent, to governance, and even in compensation, because you're now competing for the private market and also competing with some of your GPs for the talent. So that's something to consider. Secondary funds specialize in acquiring assets and securities in the secondary market. So many of these funds are just assets purchased from other investors. They offer some benefits. They can allow benefits to acquire assets at a discount. You can also gain exposure to funds that have been closed, and also you can get out of your investments whenever you want prematurely. In the end, I think it's important to mention that secondary funds really have made accessing the private equity markets easier for investors, and also have added a lot of liquidity. Again, something distinguishing the markets today from the markets in 2007. And very simply, a fund-to-fund, which you're all aware of, is a pooled vehicle, usually a multi-manager vehicle. It offers broad diversification, but comes with higher levels of fees and other expenses. The board's seen this slide before. I just wanted to touch upon a few comments about PE. It's a slow-moving asset class. The results you're seeing today are results based on decisions made years ago. And the decisions you make today, they're not going to be felt for years until years to come. But what's important for a successful program is a commitment to the asset class, a clear investment strategy, steady capital deployment through all years, and vintage year diversification, which I know the board's been discussing with staff. I just wanted to highlight that, given the fact that 40% of the capital committed is in the years 2006 to 2008. But again, that's a topic for a different discussion. Turning to page 25, this page lists the largest public pension PE investors. CalPERS is obviously the largest by size in terms of dollar, but not the largest allocation. The average public pension has an 8.7% allocation to private equity. The average large public pension has a 9.3% allocation to private equity.
Yeah, I don't want to make a comment here. If you look at this slide shows that our size is our disadvantage. Previous slide, when we set up SMAs, sometimes we could get lower fees because of our size. But here again, when we compete with our public pension peers, our side, dollar side, we're absolutely the largest private equity. Even though we only try to allocate 8%, currently our target as of this month, the latest number was only 6.7%. So we're still 1.3% short of our targets. But in the dollar, for a smaller fund, for example, the number 10 fund, the Ohio fund, right, is 9%, but the dollar amount is only $9 billion. And that's where we're trying to make a point last month as well. For a smaller program, because manager selection in private equity is of paramount importance. So, and also you want to build a diversified portfolio. The manager want to have a diversified base of investor. So if you run only $9 billion funds, for example, Ohio Public Pension Fund, they could concentrate on if you think of the GP world, the general manager world as a pyramid. So the top performance manager very small on the top. So they could focus more on the top end of it. But because we are larger, we're 3 times in dollar size, 3 times of the number 10 fund, we are forced kind of down to the pyramid. So that's why here our size is to our disadvantage.
Turning to page 27 to real assets, I'll only hit this briefly because we've already talked about this. Enhanced returns, low correlation to public markets, a stable, predictable cash yield, portfolio diversification, typically away from equity risk in particular, and inflation protection in that many of these assets are structured that enable inflationary costs to be passed on to consumers. You still have the same risks, idiosyncratic deal risk. You're dealing with credit now, so structure, credit, leverage, and some of the operational risks. There's liquidity risk, there's regulatory and political risk, even reputational risk because you're dealing with regulatory bodies. Climate, environmental risk, which is just the impact of climate change. And technology risk, which is really just new ways that are coming on the market that are making old ways obsolete, and you still have manager risk. And I did want to make one comment. Most investors in a recent Preqin study cited market risk. General market risk is the biggest risk to the sector affecting real asset investing and price appreciation. Turning to page 28, looking at real estate and infrastructure specifically. Real estate involves a purchase, ownership, management, rental, or sale of real estate for profits. The key here is building up tax-deferred profit through price appreciation, capital intensive, and highly cash flow dependent. There are really 3 strategies: core, value added, and opportunistic. Core, low to moderate risk with predictable cash flow. Value added, medium to high risk, targeting properties in need of some kind of operational improvement or have some management issues. And opportunistic, high risk return with properties that require massive enhancement. On the other hand, infrastructure involves investing in basic physical structures. Like transportation facilities, telecommunication, networks, sewage, et cetera. The largest scale in infrastructure investments or infrastructure projects usually are produced by the public sector or some publicly regulated monopoly. These investments can either be soft, hard, or critical. Soft based on human capital, hard physical systems like roads and highways, or critical essential facilities like for public health. Page 29, the board's seen as well. It's a slide that highlights how CalPERS specifically defines core, value added, and opportunistic in terms of return expectations and leverage. Core investing in real assets has historically been the predominant strategy for investors, including public pensions. However, it's interesting to note that 2018 is the first year that value added has actually surpassed core as the most attractive strategy. And again, I think institutional investors, including public pensions, are simply looking for return. Looking at public pension real estate returns by style on page 30, internally managed real estate has consistently outperformed externally managed assets. Opportunistic has been the best performing externally managed real estate strategy. And listed REITs have actually outperformed private markets. In fact, as we saw on page 20, listed REITs have been the best performing public pension investment on a net returns basis since 1998. However, they offer less diversification benefits and much higher correlation to public markets. Return is typically enhanced by leverage and a greater degree of leverage than is used in private markets. So that's what you see. Turning to page 31, this page lists the top public pension investors in real estate. Again, CalPERS is the largest by dollar value. I think the 33.4 lists real estate assets, whereas I think 42 billion is probably a closer figure for the total real assets bucket. Again, for comparison, the average public pension real estate allocation is 8.2%. However, the average large public pension allocation, again, I'm talking about public pensions greater than 10 billion, is 9.8. So CalPERS is still under that average. Moving to private debt. This is page 33. To oversimplify private debt, what we're really talking about are loans made directly to companies outside of the public market, structured in any of a number of ways. The credit exposure that you see in private debts can either be corporate, when the repayment of the loan is made from the cash flow of operations from operating companies, or it could be asset-backed, when the repayment of the loan is made from cash generated for some physical asset like inventories or property. When you look at the strategies on page 33, you can really bucket these strategies into two categories. Direct lending and mezzanine debt, typically referred to as capital preservation strategies in general. Distressed debt, special situations, and venture debt are return maximizing strategies. And I will, sorry, go ahead.
Yeah, so this afternoon in closed session, in the investment strategy discussion, we'll talk about private debt as well. As you notice, that private debt currently is not an asset class in our portfolio. And I think that's something we overlooked in the past, particularly given the changes in regulation after the global financial crisis. Private debt has grown very rapidly. So that's, again, this afternoon in the closed session investment strategy discussion, we'll have another discussion on private debt. So currently it's not in our portfolio. We think it should be.
Yeah, I would also just add to that given the variety of public debt strategies, private debt can reside in any number of places within a public pension portfolio. Capital preservation strategies can typically be found in fixed income, and the return maximizing strategies can most commonly be found in private equity. So and I'm sure you'll talk about that a little bit later as well. Just touching very quickly upon this, again, this is meant to be a leave behind, but direct lending is corporate debt in which a lender other than the bank makes a loan to a company, straightforward. Borrowers are often small to mid-sized companies and tend to be senior debt. I wanted to make one comment here, and that is, since 2008, private credit funds have really filled the financing void left by banks to small to mid-sized companies in particular post-crisis, when new regulation required that banks reduce illiquid securities on their balance sheets. So really a lot of people point to private credit funds, particularly this direct lending, as really being much of the genesis of the rapid growth in private markets in general. Mezzanine debt is subordinated debt, not senior debt, and it includes embedded equity instruments, so it's sort of a hybrid of both equity and debt characteristics. It's often used in LBOs. Distressed debt is the debt of companies or governments, for that matter, that are undergoing some kind of financial distress. You can pick these assets up at significant discounts, and it's usually these purchases are made in the secondary market as opposed to direct origination. Special situations, it's just investments made based upon some special situation that has nothing to do with underlying fundamentals. It could be mergers and acquisitions, spin-off, tenders, offers, litigation, or anything like that. Special situation investments can be made in secondary markets or as well as in direct markets. Venture debt is just debt lent to venture capital-backed companies that don't have any other option to raise capital, and often, like mezzanine debt, includes some kind of equity option so you can capture the upside, additional return for the risk that you assume. And again, here are all the potential benefits and risks. The only real thing here that's different than before is just the regular income flow. I think is significant for private debt, obviously through loan interest and repayment. Credit, default, and restructuring risk and liquidity, we're now dealing with loans. Manager selection we know about, and the quality of collateral risk, which is obviously particularly relevant for asset-backed exposures. This chart shows on page 35 the historical performance of private debt, and you can take a look at the returns here and the volatility as well. But what clearly stands out is obviously return maximizing strategies, distressed debt, special sits, and venture outperformed the capital preservation strategies, direct lending and mezzanine, with distress and special sits being the highest returning private debt segments. It's funny, I tried to figure out what these pies meant, and it's a little misleading. I actually found someone to talk to at Preqin because this chart's a little misleading. These bubbles are not the size of the private debt market segments, as what I thought they were, but rather it's just the total AUM of the managers in their database. So I don't want you to use those as a proxy for the size of the markets, but at least it gives you an indication of the data that they're collecting and the returns.
Just one thing I would like to draw to your attention. The x-axis starting point is 9%. So even the lowest risk, lowest return strategy within private debt asset class is higher than 9% historically speaking, according to this study. I think this study a little bit more on the generous side.
I think so too.
Yeah, so maybe a little bit lower than 9%, but my point is that, as we'll discuss later, keeping in mind that the x-axis starting at 9%.
I would, just to that point, I'd also notice the bubble's small, so that means there are not a lot of managers in that sample size, and this has no indication of what kind of levels of leverage that they might be using as well. So, now, and just finally, on page 36, this is a chart from Cambridge Associate that really shows the attractiveness of various credit strategies through the market cycles. You can see that senior debt direct lending is really an all-weather strategy. You can also see that distressed debt requires some sort of distress. So it typically occurs in late-stage economic expansion or contraction. And that mezzanine is most attractive in economic expansion when companies are looking to finance their growth. I think I sped through that, but if you have any questions?
Yeah. So this chart basically breaks out the economic cycles into 4 components or 4 phases. Then depending on is a income-driven strategy or capital appreciation strategy. So different part of the cycle, for example, the later part of the cycle, probably you prefer more income-driven strategy than capital appreciation strategy. But you can apply the same philosophy, the chart. This is only for private debt. You can talk about private equity, public equity, fixed income, real estate as well. For example, our real estate is a core U.S. real estate. Bulk of its expected return coming from income-driven strategy. So for any income-driven strategy, you can apply for this kind of chart. Almost all weather environment, you need the income. But for capital appreciation-driven strategy, such as private equity and in debt, a distressed debt strategy, you probably want to be early part of the cycle, not the later part of the cycle. So the same philosophy can apply to much broader sense of portfolio construction.
The only last page is a list of sources, and so if anyone wants to do anything, any additional information, I'm here to answer any questions.
Thank you. Thank you great for the presentation. We do have a few requests. Ms. Brown.
I'll go ahead and pass. Thank you.
All right. Mr. Jones.
Thank you, Mr. Chair. Thank you for a very comprehensive report on capital markets. I really appreciated the information. My question is probably driven from that last chart that we looked at because it talked about economic expansion. But when you listen to a variety of economists today, they're talking about a slow growth economy that's coming, if we're not already in it, in the next year or so. So what impact does it have on private debt and a slow growth economy at which most economists are predicting?
Sure, I'll I'll take a stab at it then. Well, it's a great question, first of all, and I think the big question you have to ask is how well are the private markets positioned for a market downturn? And I tried to highlight that they are better positioned today than they were in 2007, primarily because the market is just much more mature. So I think you're not going to see some of the behavior and managers fleeing the market as you saw back then, really depressing asset values. In fact, you might even see a large number of investors looking forward to an opportunity to pick up access at a discount. So I think with this greater market maturity, it's more liquid with approaches including secondary markets, and the conditions in the marketplace are just better than they were then. So I think there's less concern than in the past, and I think people believe that the private markets are not only pretty well positioned for a market downturn, but in some sense waiting for it.
Yeah, so I see two questions in your statement, Mr. Jones. For one is, say, if we can form an opinion on where we are on the economic cycle, say we're very late in the cycle, if we believe in that, if we are able to identify we're late cycle, you would like to move your portfolio higher up in capital structure, means more in debt instead of in equity, and you would like to be more in private assets than public assets, right? Provided that you have the liquidity, you can sustain the illiquidity of private assets. The reason is that, as I mentioned earlier on, the private markets, if you have access and you can find the very skillful managers, they do generate alpha by actively manage the portfolio. And the alpha component is uncorrelated with the market beta. So when market goes down, the ability to generate additional alpha should not be affected by the beta, in theory. So in private market, you can find that source of alpha. And if we believe in the later market, you want to be higher up in capital structure, means more in debt, less in equity. You would like to be more in private, more in private than in public, provided that you have the liquidity and access to the top private manager. So if I were running only $10 billion fund, probably if I were running a $10 billion fund, and if I were able to get to the point saying that, yes, we're late cycle now, I will move into private debt, right? I want to be in debt, I want to be in private, so that gave me private debt. So, but the first part is, can we really formulate a view on the economic cycle? That is I want to say $380 billion question. Just today, there's an article on Wall Street Journal talk about how the economists got it wrong for the past 10 years. In the past, how many years we have been saying that we're late cycle, late cycle, late cycle. The economic cycle does not die of old age. So there are two examples in front of us. We are in the longest cycle of our own history already, in the US history, but in the longest recovery cycle already. We're 10 years into it now. That's only 2 hour history. But if you look globally, there are two examples. One is 30 years in expansion, and it's still counting. That's Australia, right? And the other extreme example is Japan. It's 30 years, the growth has been no growth to low growth for 30 years, has not fully recovered. So that's a binary scenario. One side is Australia, 30 years, the recovery is still going. The other side of 30 years, has not fully really recovered from the recession. So calling where you are on economic cycle is very difficult. But if we believed that we are late cycle, and if we were running a smaller fund, I would be probably in private debt.
Ms. Middleton.
Okay. Thank you, Mr. Chair, and thank you for a very interesting, very helpful presentation. There were a couple of slides that I wanted to ask questions about. The first is on slide 20, and it's showing median return, yes. Private equity, yes. Performing at 10.2 and public equity at 8.5. Would it be fair to say that the range from poor performance to high performance in private equity is much larger than it is in public equity?
Yes, and I'll just repeat the one data point that I had on that I probably said way too quickly. Looking at returns over a 5-year period from 2013 to 2018, there was a relatively recent Morningstar report that showed the performance dispersion between private equity funds, really a very large performance dispersion from -30 to +40. Over the same time period, public equities, as measured by U.S. domestic mutual funds, showed a return dispersion of only between 5 and 12% over the same 5-year period. So the answer to your question is yes, and it's very dramatic.
So the magnitude's even greater than I suspected it might be.
Yes.
So can you talk to us about what are some of the attributes that those that are the highest performing funds have in terms of how they have managed their private equity?
You mean private equity or private debt?
Yeah. Well, I'm looking at a chart of private equity, but I'm thinking broadly in terms of private markets.
Right. So the attribute I look at, we can have our private equity expert come up as well. Basically, can you find capable and aligned manager? If I reduce really the first capable and aligned, I think that's nothing more than that. Capable and aligned, and also unavailable. That's they are willing to take our money. Not all the GPs are willing. We don't have access to all the GPs.
I would also argue that performance persistency is key, and I think nowadays, given the competition in the marketplace, there's a real focus not only on individual managers, but individual managers within the GPs, and you have money following those individuals. It does speak to a little trend in the private equity world where you got to hold on to talent. But to your point, it's really focusing on the right managers, but it's really getting down to focusing on the right individuals within the right managers. So.
Yeah, I think it's a really good question, and it's really what we spend all our time trying to figure out. And what I would say is, fundamentally, we look for managers who I would say durably add value across all cycles, and that can come in many different forms. It can come from specialized sourcing expertise. It can come from finding situations that have less competition and buying assets very well. It can come from operating assets very well, both through growing their revenue and also growing earnings. And each of these things is very particular to a situation, and each of them evolves over time. So the question we're repeatedly asking ourselves is, what is the competitive differentiation of a manager, and how durable is that? And you can see different market segments rise and fall, and a manager can benefit or not benefit in those situations. But what we're looking for is, across all cycles, someone who's going to continuously add that value for us.
And the next slide I wanted to speak to is slide 25, which looks at how we compare to other organizations. And while our allocation at 8% is somewhat less, just in terms of actual numbers at $27.2 billion invested, we're significantly larger than anyone else. And this is an industry, from what I'm hearing now, talent makes all the difference in the world. And with the size that we have, do we have the capacity to attract, manage, monitor the talent that it's going to take to be successful in this area?
Yeah, I believe we do. And I would call out on this slide, this is all U.S. public pension funds.
Right.
It does not include a number of other active asset allocators,
right,
who would have both larger allocations and larger total dollars invested in private equity. So I think there is continued headroom for us. Your question is a very relevant one, and I would say I think we will be able to grow our total dollars invested and allocation with the team we have in place today. There are certain strategies, though, that will require additional expertise, and one that we've spoken about previously is co-investing. That is one where I would expect over time for us to build a kind of a durable program and a scale program. We may need to bring in additional expertise.
Okay. My last question is for Mr. Hughes. Looking back for the responsibility that we have here as a board, what are the areas of oversight that you would recommend concentration on?
For investments in private markets in general?
Mm-hmm. Or specifically to the private markets?
It's a good question. I think, as I mentioned before, the biggest challenges facing public pensions really is on the resource side, giving staff the needed resources to effectively invest and monitor these assets. So that's the first thing, and it involves a commitment from the board level. The second thing is governance, and I think governance can extend very broadly, but it's how quickly and effectively decisions can be made. I've talked to a few public pensions and helped them think through the governance behind co-investments. You need a much shorter process and ways to do that effectively. I also think, to the degree, as Greg mentioned, you want to now delve into some of these strategies that have less fees because you're not dealing with external managers in the same way, be it co-investment or direct. You need the talent, and you've got to invest in the talent. And you've got to invest in the talent in a way where you can compete with the private market for that talent. And I think one of the issues facing public pensions in general is, as public pensions have become more sophisticated in their investment approach and investment goals, that many plans have this mismatch between great goals, not enough of commitment to the resources and the governance structure. And I think the bigger public pensions get and the more complex and sophisticated the investment goals get, there's going to have to be a realization that we need to match that with a resource commitment, a staff commitment, and a governance commitment.
If I may, I just second on what Greg and Vaughn just said. It's absolutely right that if we look globally, there are larger sovereign wealth funds have run private equity program much larger than ours, and probably with higher return as well. Currently, my assessment of our team, we don't. There are still a lot of work for us to do in order to get to what could be done. As you said, resources in terms of budget, headcounts, governance is all the issue. So we'll continue. With Greg, we'll continue to overcome each one of the challenge and keep on coming back to this body when we need headcount, budgeting, governance, and we can compare ourselves to the successful larger players. How do they do it? How do they run a program larger than us and with higher return?
Okay, thank you.
Thank you, Ms. Oliveros.
Thank you, Mr. Hughes. It's been a really interesting presentation. I was wondering if you've looked at Senator Warren's SB 2155 and how that would affect public pension plans.
I have not. My apologies.
Okay. It's the private equity bill.
Oh, to consider how private equities should be restructured in terms of investing.
Taking on the debt.
It's an interesting idea. I think it would more adequately put managers in a position of being responsible for what actually happens with the underlying portfolio management companies, but I think it does have potential ripple effects that have not been thoroughly thought out, nor have I thought them out myself. But it's an interesting concept to make or add a little bit more of accountability into the private equity investing. But what would actually happen longer term, I couldn't say.
Thank you.
Okay, seeing no other requests, thank you very much for your presentation. Great information. Brings us to agenda item 9, or item 10, summary committee direction. Mr. Meng?
Yes, Mr. Chair, I misspoke this morning. I thought it was going to be a lighter session this morning. It's well into the afternoon now. So I noted 2 follow-ups. Item 6J, on the climate risk report, there are requests from Controller Yi's office and from other board members to expand on our achievement proxy voting section, as well as adding a conclusion section. And I noticed our team, ISI team, and Ann Simpson took detailed notes. So that is one follow-up. The other one, on item 7, the private asset class in a program policy revision second reading, we will work with you, the chair of the investment committee, to finalize the exact wording of that sentence. These are the 2 follow-up that I noticed. Yeah.
Okay. Thank you. The divestment, that's going to be at a future agenda item, yes. We have to figure out when, because we're not meeting every month now.
It will be in 2021, unless the board asks to have it sooner.
Yeah. The reason I didn't put it, that wasn't part of a staff follow-up, so that's why I didn't put it.
That was my follow-up.
Yeah.
We have 2 requests from the audience under public comment. We have Michelle Lee and Alan Hansen. Please come down. You'll have up to 3 minutes for your comments, and identify yourself for the record.
Can you switch?
It's on.
Oh, it's on. Great. Good afternoon. My name is Alan Hansen. I am the field director of UFCW Local 400. We represent 35,000 grocery, retail, meatpacking workers in the Mid-Atlantic from this Washington suburbs of Maryland all the way out to Ohio, Kentucky, and Tennessee. I'm joined here by Michelle Lee, a Safeway member and a shop steward. I'm also joined by Eileen O'Grady from the Private Equity Stakeholder Project. My remarks are going to be very brief because I definitely want you to hear from Michelle's experiences working at Safeway, particularly since being acquired by Cerberus. But I'll just say that our immediate concern of being here today is that, frankly, we're deadlocked in contract negotiations, and one of the thorniest issues that we're dealing with is a significantly underfunded pension, and making sure that the companies that have made a promise to provide retirement security to folks honor that commitment. But we have a larger concern here, and that is that since being acquired by Cerberus, we have serious concerns about the long-term financial health of this company. That since 2015, 7 private equity-owned grocery stores have declared bankruptcy, and that those bankruptcies have impacted 125,000 workers. And we see a very similar model in all of these bankruptcies, that a private equity firm purchases the company, grows the company significantly through a series of highly leveraged transactions, sells assets, namely grocery stores, and leases those assets back to pay down the debt, and then balances the books on the back of workers. Those are serious concerns. Safeway alone has 275,000 employees, including a significant number of UFCW employees, of Teamster employees, all of whom enjoy the retirement security that unionized employees have long enjoyed in this country. And so we want to make sure that Safeway doesn't go the same way that these other private equity-owned companies go. That Safeway makes sure that not only do they honor their commitment to workers in the Mid-Atlantic and all across the country, but that they also make sure that when they exit their investment when Cerberus exits their investment in Safeway, that they leave the company healthy enough to sustain good jobs and provide access to groceries in communities across the country. And so with that, I'm sorry, one more thing. We shared a report with you that I see some folks reading. Would encourage you all to take a look at that. It elaborates on the comments that I made here. And with that, I'll turn it over to Michelle Lee to talk to you about what it's like to work at Safeway.
Thank you.
Good afternoon. It's a pleasure to be here. My name is Michelle Lee. I am a 32-year employee of Safeway and a member of UFCW Local 400. Our union represents over 6,000 Safeway Albertson workers in the Washington, D.C. metropolitan area. In 2013, an investment group led by the private equity firm Cerberus acquired Safeway. And since then, working conditions and our customers' shopping experience have gone down. CalPERS is one of the investors in the fund that acquired Safeway. Under Cerberus, Safeway has dramatically cut hours, leading to long waits at the deli counter and at the cash registers. Sometimes the lines are 10 to 15 people deep. Shelves are empty due to understaffing, and stores are not as clean, safe, or maintained. For example, the refrigerators in my store are always breaking down. The coolers are not deep cleaned, causing excessive dirt and mold buildup. We lose sales every day because we don't have enough staff in the stores to keep the shelves stocked, nor enough registers open. But that hasn't stopped Cerberus from making money. Since 2013, Cerberus-led investment group has taken over $350 million in management fees and dividends from the company. Now Safeway tells us that we must take concessions. They refuse to commit to adequately fund future pension benefits, placing my pension and the pension of more than 50,000 current and retired Safeway employees in the Mid-Atlantic at risk. They also want us to pay more for health care, keep new hires in Washington, D.C., Montgomery County, Maryland at the minimum wage, and they want to maintain a cap on hours so that present part-time workers will not qualify for health care. Many of our members already rely on public assistance to provide for themselves and their family. Safeway Cerberus contract will likely force more of my coworkers to depend on taxpayers to make ends meet. We have been negotiating with Safeway for more than 14 weeks. During that time, we have shared our story with other public pension funds with Cerberus investments, including the Pennsylvania School Employees Retirement System. We also joined with other retail workers to lobby for federal legislation that would stop private equity abusive and anti-workers practices. Your fourth investment belief states that long-term value creation requires effective management of three forms of capital: financial, physical, and human. We are the human capital that makes Safeway successful. We know our customers' names. We know their birthdays, their favorite cut of meat, and how ripe they like their avocados. As an investor in this fund that owns Safeway, we urge you to please meet with Cerberus and encourage them to work with us to achieve a successful contract and ensure that we share in that success. And if they don't, we ask that you please halt all new investments with Cerberus until they do. I thank CalPERS staff and trustees for your attention in this very important matter.
Thank you, and we thank you for your comments and for your being here today and sharing with us. This board takes very seriously the responsibility of employers to do the right thing. I do know that Mr. Baker from your organization has met with our staff a number of times. I urge you to have him continue meeting with our staff so we can keep an open dialogue. Ms. Taylor.
Yes, thank you, Mr. Chair. Thank you very much for talking to us today about this. I will say this is something that Ms. Oliveras mentioned earlier, which is the reason we need the Warren bill that's currently up at the Senate and the House, because these companies, one of the problems, and I didn't comment earlier, but one of the problems with having private equity is that this is their common practice. I know we all have a need for private equity, and I understand that, but there has to be a way to stop the debt loading that they do. $350 million in management fees? They bought the company. What do you mean management fees? I'm just appalled. The fact that they would undermine the defined benefit pension and try to... Grocery jobs used to be middle-class jobs. This is ridiculous. So thank you very much for bringing it to our attention.
Thank you.
Okay, seeing nothing else on our agenda, the open session of this committee is adjourned, and closed session will start at 2:05.